Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're tackling a big question. Would a tax on unrealized gains apply to your real estate? This idea is getting a lot of attention, and it's causing some confusion, especially for homeowners and property investors. Let's break it down. An unrealized gain is a profit you have on paper but haven't yet cashed in. For example, if you bought your house for $300,000 and it's now valued at $500,000, you have a $200,000 unrealized gain. You haven't sold the house, so you haven't realized that profit. Under our current tax system, you only pay capital gains tax on that profit when you actually sell the property. Plus, for your primary home, there's a huge exclusion up to $250,000 of gain for a single person and $500,000 for a married couple is completely tax-free. A tax on unrealized gains would flip this script. The proposal, in its purest form, would tax the increase in your assets' value every single year, whether you sell them or not. So, in theory, could this apply to real estate? The answer is complicated. On one hand, real estate is a massive asset class. If the goal is to tax wealth, excluding property would create a giant loophole for the ultra-rich to park their money. So, some versions of this tax could absolutely include real estate holdings. However, and this is the most important part for the average American, it's highly unlikely to affect you. The current proposals being seriously discussed, like a billionaire minimum income tax, are specifically aimed at the wealthiest individuals, often defined as those with over $100 million or even $1 billion in assets. These proposals almost always include huge exemptions that would protect the primary homes and investment properties of nearly everyone. Think about the practical nightmare of applying this to all real estate. The government would have to accurately appraise every single home, apartment building, and plot of land in the country, every single year. This would be incredibly expensive, slow, and likely lead to endless disputes. What happens if the market crashes and your home value drops? Would you get a tax credit for your unrealized loss? Because of these massive logistical hurdles, most proposals focus on assets that are easy to value daily, like stocks and bonds held by the super-rich. So, while a broad, theoretical unrealized gains tax could include real estate, the actual plans on the table are designed to leave the property of everyday Americans alone. The focus is on taxing the financial assets of billionaires, not putting a new annual tax on your family home. Thanks so much for watching. If you found this explanation helpful, please hit the like button and consider subscribing to the channel for more clear, simple breakdowns of companies.